right now we are consolidating before moving higher.
Give us some background and overview of who you are and why you're excited about Bitcoin.
Of course. That's awesome. Well, again, thanks, Robin, for having me. My name is Joe. I am the head of growth over at Horizon. More than anything, I'm a Bitcoin advocate, and I suppose Bitcoin salesperson, you could call it. I think anybody working in Bitcoin to some degree is a Bitcoin salesperson. So I'm just another one of those guys, right? I'm a market analyst by trade. That's kind of where I got started. Recent college graduate, 24 years old. And I've been working in Bitcoin since my sophomore year of school, and I haven't looked back. I helped found the Bitcoin layer, or rather turned it into a market research publication, multimedia publication with Nick Bhatia. I've been the head of growth over at Thea for a little bit over a year now, and now I'm working the same position over at Horizon. Yeah, a little bit about me. Excited to dig into everything we have to talk about today.
Awesome. Yeah, it's really fun. I think you've been on, I think like 8 months ago. Like I should have looked it up, but like I found like half a year to a year ago. And the price was probably about like half of where we are right now, depending on when we release this video and all those things. How different would you describe the market a year ago to now when you're back on? What do you kind of see in the market?
For sure. Yeah. I mean, looking back a year ago, and a lot of people will forget this, but we were right smack dab in the middle, if not a little bit toward the end of like a consolidation phase for Bitcoin. So I think what I can do is show my screen, and I'll show people this chart, just so people can get some sense. I'll do away with the moving averages, and I will take off the indicator there. So zooming out to right here, this is where we were last summer. If most people remember, we called this phase chop solidation. Why? Because everyone thought Bitcoin was going to break out every single time we reached here. And then everyone thought that Bitcoin was going to tank every time we reached here. But in reality, it was just coins changing hands from weak hands to strong hands, right? The ETFs launched early last year. Last summer, was a huge example of coins being sold off by some flighty retail investors and purchased by more long-lasting entities that have a longer time horizon. Now compare that to this summer. We're in a very different position, right? So, if you go back to July 21st of last summer, somewhere around here, Bitcoin was about 60-ish K, high 60s, right, to low 60s. Now we're basically double that. So, exactly as you said, it's a much different world. Bitcoin has taken two massive legs up since then. Obviously, this trend here, if you could visualize it, we've broken up and out of that trend. Bitcoin went down to, it created some volume here, went down to retest and create some more volume, and then shot back up, created some volume and then shot up, and now we're creating some more volume. And so really, the story of this bull market, Robin, and for the people viewing at home, is that this is like different than anything Bitcoin's ever done before. So really, if I put this into log scale, you'll be able to see it a little bit better. Is that, Bitcoin for the last 3 years, right? The majority of this cycle has just been, consolidating, taking a stair step, consolidating, taking a stair step, and so on and so forth. And so really what we're seeing is like a very, very mature and slow and gradual increase in Bitcoin's price. That much more, mirrors like stair-stepping secular adoption of an asset rather than the hysterical booms and busts of cycles past. I won't go all the way back to 2017, but if you go back to 2017 for comparison, you can see Bitcoin spends basically 2 years of the 4-year cycle being flat and doing nothing, 1 year shooting up, 1 to 12 to 14 months shooting up as fast as it can, and then the next 12 to 10 months, cratering back down basically by 60 or 70%. And that's just not what we're seeing this time around. You'll remember in 2022, in 2023, Celsius, BlockFi, FTX, Voyager, and a great deal of others, they exploded off the map. And that was around the time when yield was a huge thing, when other crypto was a huge thing. And now we're seeing that that's just not the case with Bitcoin, right? Demand has moved into Bitcoin. If you look at the price charts of Bitcoin relative to everything else, so really what I mean to say, to tie it all up in a bow, is like, where were we last year? Where are we today? A long-winded way of answering the question. Last year we were consolidating before moving higher. Right now we are consolidating before moving higher. Right. That's the new modus operandi of the way Bitcoin operates. That's the new path of least resistance for Bitcoin. We're moving away from these boom and bust cycles of yore, and I'm not saying we won't have a bust this cycle, but the reason we're doing it is because the people who are buying Bitcoin are no longer retail dominant. They're primarily institutionally dominant, pensions, endowments, and others who don't plan on selling anytime soon. And so therefore, you're getting a lot more consistent, stair-stepping, mature adoption. That's what you're seeing in the price, rather than this sort of crazy boom and bust cycle type stuff.
I love that because it mirrors what I've been feeling just with my gut, where I'm like, okay, we have a lot more big money coming in. At the same time, retail seems not that excited about Bitcoin right now. Like if I go out, there's here and there some old friends that call me and message me, but it's like nothing compared to 2017 when I was not even Bitcoin, but everyone was talking about Bitcoin. And it was my first kind of touch point with it. 2021 was crazy. At every smaller gathering or any party, there was talks about meme coins, about Bitcoin, about all those things. It's no longer happening in that crazy sense. I mean, that's just like my very small subjective feeling. But back then I did not work in Bitcoin, and it came up more. And now I work in Bitcoin. It comes up less in my personal life. So I don't know. It's just one man's opinion. But the retail crowd seems to be like chilling out and not be so excited about Bitcoin. But the price is crazy high compared to where we are like 1 year ago or like 5 years ago. And it's just like the bigger money coming in. And I actually just looked because I was curious. I didn't look at that chart for a longer time. The retail chart is always like, if you put in buy Bitcoin in Google Trends, you're probably well aware of that. And then it actually has a small uptick here and comes a little bit where we were when we hit the 100K last year. So I don't know, maybe retail is joining us again. But even if retail is not joining us, or even if they join and then like drop out again, the big money makes the move, right?
Yeah, exactly. And so I completely agree with you. Like before I was even working in Bitcoin, more people talked about Bitcoin and other, altcoins and meme coins and whatever. Now I don't hear a peep, and I work in the industry. Maybe it's just because I'm staying on my desk more because there's more work to do, right? But largely, it's not nearly as present as it was last cycle. That can be validated with other anecdotes, like your anecdote, which lines up with mine, which lines up with other people's, but also Google search trends, right? And so, you see them trending up just a little bit. If you search Bitcoin, just flat out Bitcoin instead of buy Bitcoin, I think it's even lower than the buy Bitcoin. And so retail is coming onto the scene at the margin. But that doesn't necessarily matter, right? Because the cohorts that have driven this buying have been these institutions, right? This is because of two distinct things, or three distinct things, rather. Like first being these ETFs, right? These spot Bitcoin ETFs allowed an entirely new cohort of investors to invest in Bitcoin. If you consider pension funds and endowments and retirees with their 401ks, whatever, none of these people had access to Bitcoin unless they wanted to take the money out of the account that they were using for the rest of their portfolio and get hit with a penalty. And for them, it wasn't worth it, right? They would buy MicroStrategy, or they would buy a Bitcoin futures ETF or something else. Then the spot Bitcoin ETFs came online. You fast forward 16 months later, 18 months later, year and a half later, IBIT is BlackRock's most successful ETF launch of all time. It's their most profitable ETF of all time, just 18 months in. And so the demand for this thing is clear. And there was a lot of pent up demand from these different cohorts for Bitcoin exposure, but it's been consistent, right? It hasn't, it didn't kind of come onto the scene over the course of a couple months and then wane. And then these people are just holding or even selling. There are more and more and more of these people every single day who are purchasing this for their pension, their endowment, whatever, their retirement account. And another thing to consider, and this is key, not only are they long-term holders, because when you're buying something for your pension, right, chances are it's going to stay there, because as people retire, they are going to take a slice of it, right? You're not going to trade in and out of things. You're going to hold assets that will appreciate over the long run so that you can pay, whether it's a cop or whatever, their pension, right? This is a cohort of buyers who are long-term thinkers. Not only because of that, but also when you consider when a business does something profitably, what do? They scale up their sales force to hire more salespeople to sell it to more people, right? BlackRock coming out with this news that IBIT, their spot Bitcoin ETF, was the most profitable ETF of theirs of all time. That means that they've hired more salespeople or they've ramped up the sales effort for IBIT to their clients, right? And so there's genuinely a Bitcoin marketing department out there employed by BlackRock, Fidelity, Galaxy, and others. All of these people who have these spot Bitcoin ETFs, they are essentially this Bitcoin marketing department, right? You know, when you think Wolf of Wall Street, cold calling people, selling them penny stocks, it's a little bit different, right? Because obviously these are, institutional allocators who buy things on behalf of their clients. However, there are now massive teams of sales forces all around the world in every single time zone who are calling their client list to talk about IBIT or talk about FBTC or talk about any number of other spot Bitcoin ETFs. So like Robin, you're doing what you do as a Bitcoin podcaster. I try to do what I do as a Bitcoin podcaster and video guy. We are Bitcoin salespeople, but the folks at Fidelity and BlackRock who are trying to sell this ETF to people, they too are Bitcoin salespeople. They're motivated more so by profit rather than, the Bitcoin ethos, but all the same, they're Bitcoin salespeople. And so that's why you see such consistency in Bitcoin's price. Those two factors, I guess three: the size at which they're allocating, the type of allocators, and the fact that they're long-term holders, and also the type that this effort is scaling because these vehicles are so profitable for the companies issuing them, and so they're selling to more people.
It's super interesting. It's kind of the first time where Bitcoin has a professional sales force and marketing budget. I mean, yeah, we always had a sales force and we're getting orange
Right.
pilled. We are telling our friends and families about it, which is the most important thing. But those are people that actually sit down and call people and go about strategically about that. And they are selling Bitcoin. I always find it funny when we call ourselves salespeople because we are not selling Bitcoin.
Yeah.
It's an interesting thing. But it is changing the market behavior, I guess, for Bitcoin. I'm wondering a lot what implications are there. And I know we have probably in every cycle to talk about super cycles, about the cycles changing, about, oh, maybe we don't have the down year and all those things. But this time around, it really looks different. I mean, it has been said probably the last 8 years and 12 years also. But this year, it seems with the bigger and bigger influx of money and also more this stairways kind of a approach, maybe we don't have that blow off top, but then also not the crash down. Is that reasonable to think that we just slowly getting adopted and slowly kind of maturing without those crazy volatile cycles and down years?
It certainly is one way to look at it. And I'll actually, while I'm saying this, I'll work on pulling up a weekly chart to demonstrate what I mean here. But because we're spending so much time at each one of these levels, and because we're really making people bored and there's so much volume at each one, there was so much volume at 60K before we moved up to 90K. There was so much volume there before we moved down a little bit, right? And then because we moved down a little bit, the only reason we did was to create more volume. And then we moved up, created volume, and moved up again. And so it's this pattern that just wasn't present in 2021, 2022. I will show my screen here to showcase kind of the difference. Honest to goodness, these two charts look like these two sides of the chart look like totally different assets. This is 2020 through 2022, and then this is 2023, 2024, and today. So you could see here from September of 2020 all the way through February of 2021, basically 5 months straight, or you could say 7 months straight, all the way through April. It was basically just nonstop rising for Bitcoin. If that had been the exact same case over here, Bitcoin would have hit its top in August of 2023. Instead, in August of 2023, Bitcoin was at $29,000, right? And what did it spend the summer doing instead of rising and ripping through the stratosphere like it did in 2021? It spent the summer making people bored, right? And then it moved a little bit higher throughout the fall. Again, it moved a little bit higher into the early summer. And then what did Bitcoin spend its summer doing? Making people very bored, right? Every time you see Bitcoin range sideways here, That's building up a strong and firm foundation in case Bitcoin crashes through any one of these floors, right? So the more time you spend at a level, the more familiar people are with it, right? The more people's average cost basis, their buy-in price, their purchase price is at that level. And so therefore, the more solidified that level is as a level that Bitcoin could bounce off of should it crash, rather than crash directly through it. So that's what you see when an asset is maturing. It's spending a lot of time at these levels before ascending higher, and in doing so, like not only is the front facing Bitcoin behavior suggesting that chances are there's a low likelihood of a huge blow off top this cycle because it's not ascending through the clouds, it's taking its time. But also because we're taking our time, it makes it so that should Bitcoin fall, chances are it won't be this typical 60, 70, 80, or even 50% Bitcoin crash because it's spending so much time at these other levels. It represents a lot of people's average buying price, and therefore they'll be more than willing to step in at those levels or above those levels to make sure that they don't lose money, right? To make sure that their profit isn't negative. And so that's a fundamental difference. You can see here, right? We spent no time here, no time in this region, and that's why you saw it channel around a little bit, and then it ended up crashing, right? It channeled around a little bit, and ultimately, we created volume here over the course of basically almost a year. We created volume here, or 6 or 7 months. We created volume here, but then ultimately there was nothing here, right? This entire zone had nothing going on in it in Bitcoin's entire history, basically. And so it cratered, right? Until 20,000, which was a level that it spent some time at over here, and in 2017. And so it's all about like how familiar are these levels, right? In 2021 and 2022, it completely crashed after it reached these levels because the market got over its skis. It was pumped up by retail fueled leverage and speculative mania, and then it cratered back down to the ground all the way through every single consecutive level that it hit along the way because it spent no time there. This time, it seems a little bit different. It seems like because of the way the market is rising during this cycle, because of the time we're spending at certain levels, the market's behavior suggests to me that there may be a lower likelihood of a blow off top, and a subsequent huge crash this cycle.
This just reminded me that when we had in the past always those crashes, and they always kind of got triggered by something like an FTX or people getting leveraged with Celsius and what was the BlockFi and the other platforms. Do you see that this could be a risk? I personally see more and more people getting in, like borrowing against the Bitcoin and leveraging against it and taking out personal loans for like short term and like high interest rates and all those kind of things. Where I'm like, I don't know, like the trend towards doing the sailor strategy, which is not really the sailor strategy because he gets long-term loans and like very low interest rates. And then all I see online is like high interest rates and low duration loans. But do you see that this might become a problem? I don't think like it's too overheated right now, but like it could become a problem if the prices more rising and people kind of FOMOing in and like, oh, I also want to get to half a Bitcoin, but I only have like 10,000 euros and half a Bitcoin is like, I don't know, $80,000. Let's just borrow it and like do it that way.
Right. So there are always risks, right? And it's good that you brought up BlockFi and Celsius. And the one thing to get across with what those platforms allowed people to do was essentially it allowed them to post their USDT or their Bitcoin or another token, right, as collateral. Allowed it to basically, like, these platforms were marketed, their yield products were marketed as a black box. You put your Bitcoin in here, and then more Bitcoin comes out of it. We're not going to tell you what happens inside the black box. That's that's only our information. But as far as the customer knew, there was a black box. They deposited Bitcoin into it, and then more Bitcoin came out. And so ultimately what was revealed was that basically they were using customers' money and then lending it out to extremely risky borrowers, just like a high yield, just like basically a bucket shop, like an extremely high risk bank. That's what these customers were doing. Basically, these customers, you tend to see like 12% rates on Bitcoin backed loans. Basically, during the 2021 and 2022 cycle, um, these customers, these platforms were the lenders. They were on the lending side of that. And so then it blew up spectacularly in people's faces. And now that's not to say these platforms were, basically extending Bitcoin-backed loans. I don't believe they were. A lot of it was using that borrowed money and then going and speculating on it in the market. A lot of it was, lending to somebody who's an extremely high risk borrower with low likelihood of paying you back. Think of it this way, right? Like if the risk-free rate in the market right now, the U.S. Treasury rate is proverbially risk-free. Obviously, there's inflation risk, but from the standpoint of default risk, it's zero. In nominal default risk. You consider the risk-free rate at like 4.5% right now, and you see, FTX offering 15%, or whatever. Where is that 11.5% coming from? Why is there 11.5% or 1,150 basis points more for giving my money to FTX than there is for giving my money to the U.S. Treasury? That's the risk premium associated with the type of contract you're entering into, right? Loaning money to FTX so that they can then go loan it out to somebody else has a risk premium that's worth 1,150 basis points over the risk-free rate. But the risk-free rate is current. I'm just taking these examples, and so it was an extremely risky endeavor. Customers didn't know what they were doing. This wasn't being marketed accurately or in good faith at all. It was extremely deceptive. That said, we fast forward to today. All of these bucket shops have kicked the bucket, per se. BlockFi is no more, Celsius is no more, FTX is no more, so on and so forth. Those yield schemes are fewer and further between, right? You still have the Coinbases of the world who are talking about earning 5% or 6% or whatever on USDT. Okay, that's not nearly as, that rate suggests it's not nearly as risky as what FTX was offering. It's only about 250 basis points over the risk-free rate. So you still have some people here and they're doing it. But like you mentioned, the prevailing trend is Bitcoin-backed loans. Like doing a sailor strategy, like you mentioned, requires intelligent leverage, right? In order to speculative attack the dollar by buying Bitcoin. That's it, right? The sailor trade is doing a carry trade. It's borrowing in a low interest rate currency, right? Or borrowing at a low interest rate in a currency, either one or both, which is the case with the US dollar, and then using that capital to invest in a higher yielding or a higher rate of return asset. That's Bitcoin, right? So, this has been done through centuries and millennia, but the most popular carry trade today, particularly in the United States, or a growing, a trade that's growing in its popularity is this Bitcoin US dollar carry trade, where the sailors of the world are borrowing at essentially 0%, right? They're doing this, these convertible bonds at 0%, in these preferred stock offerings at a really low rate. And then they are using that capital to invest in Bitcoin. It's only profitable because on the front end, the rate is basically zero. It's essentially free money. And therefore, there is very little, if any, liquidation risk, price-related liquidation risk on the BTC. If anything, the price-related liquidation risk is very low because of the rate that they borrowed at, right? You take a look at Bitcoin-backed loans, it's kind of the opposite story, right? You need to post quite a great deal of collateral on one side. And then on the other side, your Bitcoin is open to liquidation risk. And then to top it all off, you're going to be paying like a 12 or 13 or 14 or 15% interest rate instead of the 0% rates that Sailor is doing. And so ultimately, that is not, in my mind, intelligent leverage, right? Intelligent leverage is ultimately leverage that comes with low or no price-related liquidation risk for Bitcoin, right? Low or no Bitcoin-related price liquidation risk, right? Because what that allows people to do, and then you pair that, so the definition of intelligent leverage would also include a low rate, particularly a rate that is lower than the rate of inflation. If you have those things, even if you just have a rate that's lower than the Bitcoin appreciation, that's fine. But you still get into the danger of Bitcoin-related price liquidation risk. So using intelligent leverage, like public companies can do it, dudes with huge balance sheets can do it. They can get better terms at a bank for, like an asset-backed loan, for example. But like Bitcoin-backed loans in their current state, in my mind, are not intelligent leverage, right? And so people do have to be careful, right? I will say that these are far fewer and further between. Whereas during FTX and Celsius, it was the promise of free money. This time it is, the terms are basically upfront. Look, you can have a Bitcoin-backed loan, but you're going to pay me 12%, right? Rates starting at 12% APR. It's all over the place, right? So the risks are far more apparent. I think people are being far more prudent. with it. Even though there's been this rise in Bitcoin backed loans and this rise in Bitcoin adjacent credit products and debt products, I do not believe that people are over their skis like they were in 2020 and 2021, at least to the extent that they were, because of what was being offered then, the types of investors involved then versus what's being offered now and the types of investors involved now.
Thank you for watching this video. This was only a snippet of the podcast. And if you want to watch the full episode and get all of the context of this episode, you can click right here or here. Oh, maybe also here.